Here's the question for today from Reddit. Should I increase my S Corp salary to increase my solo 401k company match? What's going on, guys? Welcome back to the channel, or if this is your first time at our channel, welcome to the channel. My name is Travis Sickle. So let's go ahead and answer this question. Actually, let's read the full question. So we're talking about increasing your S Corp salary so you can get more into your solo 401k. So let's go ahead and read the full question here. I've been trying to do everything I can to max out my contributions to tax advantaged investment accounts. I own an LLC classified as an S Corp. I have a solo 401k to which I am maxing out both employee and employer contributions, at least based on my current salary, which is the subject of the question. If my salary is $9,000 a month, $108 for the year, and the company contributes the maximum 25% of my salary, which is $27,000 a year, and that to the 19.5, which is the employee contribution max, and it totals at $46,500 per year, which is well short of the maximum total 401k contribution of $58,000. $58,000 is for 2021. That is the maximum you can contribute for both the employer and the employee. And they finished up by saying, does it make sense to increase my salary in order to increase my employer contribution? In particular, I am concerned about the effect of the increased salary resulting in increased payroll taxes. And that is valid because it will increase your payroll taxes. So if you are taking more money as a W-2, that's going to pull it into the W-2, which would increase the self-employment tax at 15.3%. So that is a valid concern. Now, above and beyond the Social Security match or max, you would only have to pay on the Medicare portion. So not the full 15.3. So let's go through some of this math. So the first thing we want to do is we want to look at the math. I want to talk about some credits that you might want to look at. And also I want to look at a non-deductible, which really is known as the mega backdoor Roth. So let's go in order here. We'll start with the math. I'm going to bring it up on the screen on the overhead so we can see this together. So $142,500 is going to be the max on Social Security for 2021. And this individual is making $108,000. So just to show this part of the math, that is a difference of $34,800. Now, it doesn't matter which side it's on, if it's a distribution or if it is on your W-2. So either or, it's going to be added to your federal taxes. What is in question here is whether or not it's going to get added to your self-employment tax. So the W-2 will hold your self-employment tax. That is one of the benefits of the S Corporation, is that you can split the two up. And this is where you really notice it when you're below the Social Security threshold. Although above that is still the Medicare at 2.9, 1.45% for both the employee and employer, above that 142,800. So let's go back to the math here. Let's go back to the math here at 142,800. We have $34,800. If we multiply that by the 15.3, we get $5,324.40. And you can see I was just looking at the Social Security before to see what that would be. But you're going to pay an additional $5,324.40 on self-employment. However, you can only contribute up to 25% of your compensation in addition to your 19.5. So that means $8,700 goes into the 401k. Assuming you're in the 22% tax bracket, you're only going to save $1,914, but that's not even net, that's gross, because you're still going to pay this in addition. So purely from a taxable standpoint, in the year of making that contribution, it doesn't make sense to do it if it's just based on that, okay? So we want to take a look at that. And where does the max come in over here? That is going to be taking $38,500, and we're going to divide that by 25%, which will give us $154,000. And I'll do that in reverse for you. $154,000 times 0.25 is $38,500. Now, where do we get that number from? 58,000 minus our employee contribution of 19.5 leaves us with $38,500. So that is really maxing it out. Now, there's another alternative that we're going to talk about in a second, but you also want to pay attention to the credits. So this is just looking at the federal income tax and then pulling in the self-employment tax. But things like the premium tax credit, if you're on a plan through the healthcare marketplace, then you might want to look at your premium tax credit threshold, which goes up to 400% above the poverty line, depending on your household size. And that's like a cliff. So that could save you a ton of money if you can get below it, whatever that threshold is for your area and your family size. So it depends on a lot of different factors. So if we can get more money pre-tax, a little bit, even though from the federal income tax and the self-employment tax standpoint, it did not make sense, it might make sense with the premium tax credit. There are other credits you want to take a look at too, like the stimulus checks. If the third stimulus check that you didn't get the full amount or you didn't get any of it and you actually qualify for it by reducing your adjusted gross income, then guess what? You might, or your income, you might actually qualify for more stimulus money. And there are other credits that you want to take a look at too. It really depends where your total federal income tax liability is going to land, and then you want to take a look at those credits. But the third option, the other one that I want to talk about, is making the non-deductible contribution. Now, this might likely to require a different plan, because while a lot of the plans that you can open up a Roth, you can do a conversion. To make a non-deductible contribution, you need a special plan, and you might actually need to get different plan documents for your solo 401k. But then you don't have to touch anything with your income. You can keep it at in this example, you can keep it at $108,000 and still get in additional money, but it wouldn't be pre-tax. So that credit section, if you won't qualify for any credits, then the math obviously doesn't really make a whole lot of sense to do it if that's what you're trying to accomplish or that's what you're trying to look at. But you can make additional contributions into that Roth side by making that non-deductible, immediately converting it into the Roth side. Of course, there's legislation going on right now that might eliminate all of that, so you might not be able to do that for much longer, maybe only for 2021. But that is an opportunity. You can get $58,000, which without even touching your paycheck. You don't have to do anything different. You just change your plan, the solo 401k, make sure that it can accept non-deductible contributions, and then you can get right up to the full amount of $58,000. And then you're getting a balance there. So you're also getting the traditional side and the Roth side. And if you can get if your income is low enough, you might even qualify to do the Roth IRA in addition to that for another $6,000. So that is something that you can think about. So it's not going to be the same for everybody. It's always a little bit different, and you have to look at the entire situation. If you isolate just one thing, you might get blinded and miss the credits and miss those other opportunities, like having more money in your Roth side. So take a look at the full picture if you're also contemplating adjusting your W-2 wages in order to get more money into your traditional side of your 401k. So that is a question from Reddit. If you have questions, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.